To lead us through financial projections will be Charlie Tillett. Charlie has got a vast experience in all things entrepreneur. You've done several different companies, have done everything from startups to public company financial positions. I think you were on the winning team in the second or third year of what is now the 100K?
First year, but third place, and it was called the 10K back then. So
and
we've had some award inflation, I guess.
Yeah. So what did you get? $1,500 or something?
No, it's more like 300 split between we came in third place, so we got 300 split between the three of us.
Well, I could go on and on about Charlie, as with all of our experienced speakers, but I do want to talk a little bit about the spreadsheet that he's going to walk through, as I think you're still going to use that spreadsheet today.
Correct.
I have encountered that spreadsheet in many contexts. I was in Istanbul mentoring a team in an international competition. They were from Pakistan, and they started to explain something, and I looked at the numbers, and I looked at the spreadsheet, and I said, "Where did you get that?" And they were trying to explain to me what the numbers were. It was definitely your spreadsheet off of the Nuts and Bolts site. I was at the wedding of a friend of ours' daughter, and the groom came up to me when he heard my name, and he said, "I used the spreadsheet from Nuts and Bolts to launch my business." And I have to say, I've recently used your spreadsheet and modified it for things like FDA clearance that I'm working on right now. So we thank you for your contribution to all of us. With that, I'll turn it over to you, Charlie. Take it away.
Great. Let me start sharing my screen here, and then we'll go through this. Now, let's see if I can get this. Are you seeing the full screen there?
We are. I am.
Okay, excellent. Yep. Excellent. So tonight what we're going to do is we're going to talk about putting together your business plan financials. As you know, when you're talking to investors, they're going to want to hear about all the great things the other speakers have been talking about. Who's your market? Who's your customer? What's the product? How are you going to get there? But at the end of the discussion, they're going to say, we want to see some projections. We want to see the business model. We want to see the income statement. How much cash are you going to need? And so putting together, we're going to talk about putting together your financials, and we have a spreadsheet template that is filled in with some numbers of kind of a dummy company, but we'll walk you through how to put your own numbers in that so that you can have a credible financial projections both. So we'll talk a little bit more about why you need to do that. And then if we have enough time, we'll talk about how to divide equity in your startup company. And I also have a companion spreadsheet with that where you can plug in real numbers, real financing information, and you can see what happens to your ownership, which if it's two founders and they're at 50% each, what happens over adding a bunch of employees and going through multiple rounds of financing, how much equity you end up with. So let's see. My background, as Joe mentioned, I was third place in the 10K contest. I also spent an internship at a venture capital company, and it really gave me a great insight to sitting on the other side of the table, negotiating with venture capitalists. I was in the 90s, I was the CFO of NetScout Systems, which made network diagnostic and monitoring equipment. We grew that from 9 employees up to probably 200 employees and went public in 1999. I then, after taking a little time off, I joined a company that made bomb detection equipment for aviation checked baggage. So bags, suitcases that are going on airplanes, and very different experience between the two companies. NetScout, we bootstrapped that from day one. And finally, we did our first venture raise after we had gotten to $6 million in annual profitable revenue. And our first financing was at a $54 million pre-money. We'll kind of go through some of what this all means, which meant that we raised $6 million at a 54 pre, which meant we gave up 10% of the company. Reveal Imaging Technologies, we had to do our first financing before we had even really started on the product, and we raised $5 million on a $5 million pre, which meant we gave up 50% of the company kind of before we had even gotten started. So, but we had no option at Reveal because we were involved in a land grab situation. There's 492 public airports in the United States, which was our primary market. And once they had one of our competitors' machines, they didn't need ours. So it was still a successful company for both our for our management team as well as for our investors, but a very different experience there, certainly for the CFO. And I'll walk through some of those transactions, I think, on the next slide here. Before, let me just ask a couple of questions. When I was, let's see if, okay, there we go. So when I was at the Sloan, we had more work than we could handle. And one of the opportunities I used to catch up on my casework was to study in bed. Some nights I would end up like this, but what I often found the next day was by reading that casework the night before, thinking about it the night before, the next morning I often woke up with new insights into the case that I was thinking of that had been assigned to us. I had a professor at Sloan who gave us a homework assignment one night. And Tuesday's assignment was he sent us home and asked about to write down, not spend a lot of time, but write down 5 or 6 things that we hope to accomplish by our 10th year reunion. So I went home that night. Again, he said, don't spend a lot of time. This isn't all professional. This is personal, professional, what's ever important to you to have completed by the time you come back for the 10th year reunion. I put it in an envelope. I marked the date. I wrote it down in February 14th, 1991. On Thursday night's assignment was he asked us to write down the 5 or 6 things we hope to accomplish by our 25th year reunion. I must have dated these both the same, but that was actually written 2 years later. And as you notice, this one says open in 2016. Here's my sheet of what I had in my 25th year, by my 25th year reunion. And those of you in the audience tonight are helping me continue to accomplish one of my goals that I set for myself back in 1991, which was be a mentor and angel investor for small startups and entrepreneurs. And I had forgotten about what I had written in these 2 envelopes by my 10th year and certainly by my 25th year reunion. What was surprising to me, and not to say this to brag about myself, but by my 10th reunion, I had accomplished almost everything on that list. And some of the things that I had set for my 25th reunion, I'd accomplished by my 10th year reunion. So my theory is that like studying a case before you go to bed, your brain thinks about it at night and you come up with new insights the next morning. By writing these goals down, even if you forget about them, your brain will continue to work on them and you'll continue to work towards these goals. So I really am a little mad at myself. I wish I'd set more aggressive goals to have accomplished in my life. Maybe I would have had 5 startups that I'd taken public. But it drives home the point as something that Bill Gates said, and I think that holds true as you put together your business plans tonight, is that we overestimate what we can accomplish in a year, but we underestimate what we can accomplish in a decade. So as you put together that first year plan, people are super aggressive about what they can get done. And I don't want to say things peter out in the later years, but really you got to recognize how hard it is to build that foundation in the first year or two. So I would just ask you to humor me and either tonight, sometime in the next 48 hours, if you don't do it by this, what's today, Wednesday, if you don't do it by Monday, it isn't going to happen. But go down and write down 5 or 6 things. Don't spend more than 2 or 3 minutes, 5 at the most. Put it in an envelope, put it in a drawer somewhere, and then contact me in 2046. Actually, I should have changed that. This is from last year's presentation. This would be 2027. And I know what some of you are thinking. Some of you are thinking I'd be a hard guy to get a hold of, but my email's on here. And if you just Google me in 2047, I'm sure you'll be able to find how to get a hold of me. And some of you are also thinking whether I'll still be around or not, but I checked the IRS life expectancy table and I'm just going to make it to your 25th reunion. So just humor me on this. You will thank me in 10 years and 25 years, just because it will be a fun experience to open that envelope and say, gee, what was important to me 10 or 25 years ago? So why are you here? I have to say, this normally is an in-person presentation, and this is your opportunity to talk about all the reasons why you're here and what a CEO does in a company. So I'll just have to answer for you. But some of you want to start a business, some of you want to win the 100K contest, and as CEO, a lot of people say, what's my number one job is to build the product, to build the team, to find the right customers, all the things all of the other speakers have been talking about. And yes, those are critically important, okay? But if you don't have the funds to support your company, then none of those, you can't reach any of those goals. And so think of the cash as the oxygen for your company, and your job is to make sure that your company has enough oxygen. So when we think about the financial plan, it has two purposes. One is it helps you determine how much cash you're going to need. And it's also the vehicle. As I mentioned, when you talk to investors, they're going to want to see your financial plan. So it's the vehicle that will help you obtain that cash. But you need to know, do we need 2 million and then 5 million? Do we need 5 million and then another 5 million? Do we need it in 6 months and then in 2 years? Do we need it right now and then in 3 years? It helps you figure out how much cash you need and when you're going to need it. Everyone says, listen, how can I put this together? Because I don't know, I don't really know how this is going to play out. And investors aren't going to believe this anyway. One of the fallacies that people have is they think, well, the investors are going to look at my projections and realize that I'm being optimistic, so they're going to cut them in half. So I should be crazy optimistic so that when they cut them back, they'll still be interested. And I think that damages your credibility and actually hurts your ability to raise funding. You're better to go in with a credible plan that has modest goals, that you have a high degree of confidence about meeting, than wildly optimistic goals that sure might be a grand slam home run for the investor, but have much less likelihood of coming to fruition. So by explaining your financial plan to an investor or to yourself, really, it helps you understand the assumptions that you're making about your business, what the key drivers are of your business. So I'll give you a simple example. You could say, well, we could increase sales by 10%, right? Or we could increase prices by 20%. I mean, it's obvious in that scenario that um, um, it's better to increase the price by 20%, but the 20% increase in price is going to be all gross margin. It's going to be all profit. Whereas increasing the sales by 10%, you're going to have your cost of goods sold in that, and it's going to be less. Even if you said 20% increase in sales versus a 20% increase in price, the 20% increase in price is going to have a much more meaningful impact on your bottom line or your cash flow than increasing the sales. So it just helps you understand those dynamics about your business. The second thing that I think is important is it helps you understand what milestones you can complete by what period of time. So can I get a beta version ready in a year? Can I have my first customer in a year? Can I have my first customer sale in a year? And so those are all milestones that investors are going to want to hear about. And the financial plan helps you figure out how much money you're going to need to get to those milestones. Because oftentimes meeting those milestones will be the right time for you to raise the next round of funding, because by meeting those milestones, you'll be able to increase your valuation. In the second half of the presentation, we'll talk a little bit about venture capital valuation. I don't think you guys have gone over that. And you'll kind of understand the pre-money, post-money, and it's a bit of a it's a lot of math. It's not complicated math, but it's a lot of math. But you'll have a copy of the spreadsheet in your presentation, and I think by looking at reviewing those two, you'll be able to figure out. So what is so I mentioned Reveal Imaging. The company was founded in Q4 of 2002, and literally within 90 days we raised $1 million of angel money. But as soon as we started looking for angel money, we started raising our VC round. We expected that to take 6 months, and it did. And the angel money, though, was enough to get us started, to get key employees hired, to start buying material so that we could start building our prototype. And when the VC investors came to do a site visit, we had something to show them. So it gave them something credible that they could see happening. We did an equipment line, we did a bridge loan. I kind of won't bore you with all of these, other than look at the dates on here and recognize that kind of every 2 to 3 quarters, sometimes every 1 quarter, we had some type of funding event. Oftentimes, well, I would always be thinking about the next funding as we were closing a round of funding, and sometimes I'd be thinking about the next 2 rounds of funding. By looking at my financial plan, I knew what milestones we could meet. I knew when we would run out of cash, and so I would start queuing these financings up well ahead of time. And that's kind of the secret. That's, you can't wake up on Friday and say, we're not going to be able to meet payroll. You need to wake up on January 1st and say, we're not going to be able to meet payroll on April 1st, because then you have enough time to do something about it. So what is the business plan? What is the financial plan? I think that it's really nothing more complicated than a profit and loss statement, also called an income statement. And I know that we've probably got some Sloan grads here or Sloan students here. I know that we've got a lot of non-Sloan students. So just to get everyone on the same page, I just want to walk you through this, and bear with me if this is, people who've taken a couple of accounting classes. So the top line is your sales line or revenue line. And in this case, it's $50 million. And this would be after any discount. So if a customer places a big order and they get a 10% discount, you don't get to record that as a $50 million sale. And then somewhere in here, you put less discounts and knock it down. Your sales revenue is when you send out an invoice to someone, it says, pay me $50 million or pay me, $500,000 or pay me $5,000. That 550, that's the number that you get to count as revenue. The cost of goods sold is what it costs you if you're producing a product. It's what it costs you to build that product. So if it's a hardware product, it would be all of the components that go in it, but it would also be the labor that went into manufacturing it. And it would also be the support costs. So if they get a year's worth of free support, cost of that gets included in your cost of goods sold. What it doesn't include is your R&D, which is your engineering department. So all of your software engineers, mechanical engineers, algorithm engineers that are building the product that's getting sold, those do not count as cost of goods sold. Those are down in your research and development. You subtract these two numbers and that gives you your gross profit or gross margin. And as I like to say, a healthy bottom line starts at the gross margin line. And investors will really focus on this number. And the reason is I've worked in companies that have an 80% gross margin and companies that have a 50% gross margin. It's a lot harder to make money when you have a 50% gross margin. Just think about it. You've got 30%. We're only spending, in this example, we're only spending 45% on departmental expenses. Imagine if you had an extra 30% up here, how much more you could do in these departments down here. Your three departments are going to be sales and marketing, research and development, and general and administrative. So sales and marketing, I think, is self-explanatory, as is R&D. General and administrative would be your accounting department, your CEO and CFO would be in there, your HR department. If you have an internal information technology department, that would be there. These are the services that are used by everyone else in the company. I don't like early stage companies' financials to be overly complicated. So I put all of the rent into G&A rather than say, oh, the sales and marketing has 25% of our staff, so therefore they should pay 25% of our rent, and that would increase this number. At the end of the day, rent gets paid, and we're not trying to, we're not Google or IBM here. At the end of the day, we want to see what the total expenses are and what the operating profit is.
Excuse me, Charles. Yeah. Okay, if I ask a question, so the percentage column always kind of throws me off. It's because it doesn't add up to 100, and like the first line says 100, then it's 40 and 60, which
okay. Oh, great. Yeah, so great question.
What is it? Percentage of what?
Yeah,
which line?
Yeah. Got it. Okay, great question. So what we do to get these percentages is we take every number here and divide it by the sales. So sales is always 100%. So cost of goods sold is 20 divided by 50 is 40% of our sales. Gross profit is 50 minus 20. So a gross profit is 30 million. 30 divided by 50 is 60%. So all of these numbers are percentage of revenue. Okay, does that make sense?
They're all percentage of revenue. Okay.
Right. So let's just take operating profit at $7.5 million. Okay, 7.5 of 50 is the same as 15 of 100, 15%. Right.
Uh-huh.
So in my mind, and that's a great question, because when I talk about building your financials, I urge you to look at this column as much as you look at this column. Okay. And investors, if you don't put this column in your presentation, they're going to start doing the math themselves to figure this out. So if you just show them 50, 20, 30, they're going to say, okay, see 30 by 50. Okay, you guys have a 60% gross margin. Well, you might as well do the math for them, because that way they don't screw it up and give you start evaluating your business on the wrong information. Okay.
Yeah, so I guess they're comparing that to benchmarks. Then it's not like 30% the right amount of investment in sales and marketing is 60% the right gross margin.
So good question. We'll talk a little bit about that. At the end of the day, I'll actually show you some examples of various industries. And it isn't that your business model, which I'm going to call these percentages, has to be anything, right? It's your business. You come up with what the model is. But what you need to be prepared is that if you're in the hardware business and your percentages are way off from other companies in that industry, you need to be able to explain why you're either going to be way more efficient, or you're going to need less sales and marketing. So it's not that it's wrong, but you need to be prepared to answer the question. And so I'll show you some examples in some of the next slides. Okay. So, so we talked about your income statement in percentage terms. To me, what the percentages are in the early couple years don't matter, because you haven't reached critical mass. So what is important is that once you reach some sort of critical mass, I don't know, for you, you have to decide, is that 5 million? Is it 10 million? Is it 3 million? Where you either get some sort of unit volume, maybe unit volume discounts that make your business flip from unprofitable to profitable. Maybe it's geography, where you need to cover the whole eastern half of the United States, or the whole United States, or maybe all of eastern Massachusetts, or some number of transactions or customers. So, we all appreciate economies of scale. And so what you need to show your business once it reaches that level of economy of scale. And what does the business plan do? At the end of the day, you've got to document that your business can make money. Okay. I understand there's a lot of companies out there that are showing losses as far as the eye can see, and some companies can raise money under those situations. I would urge you not to count on being one of those companies. Ezzy.
No, it's Esgy, no problem.
Ezgy,
I've got a few
Ezgy.
questions from students here.
Okay.
Here, Amy's asking, the R&D is only for 10%. How about for early stage, which needs R&D to build product?
Beautiful.
And then Samid
we will get.
Saying, is the ratio of marketing to R&D so high?
Okay. What was the second question? Because the R&D question will be answered.
Samid says, is the ratio of marketing to R&D usually so high?
Okay. So we'll get to that. We'll get to both of those. Okay. Just trust me.
And then we also have one more follow-up from Amy saying, what are the line items of the cost of goods sold?
It's all in the spreadsheet.
Fantastic.
All right. So you're great. You're thinking ahead. So so the top line is what gets the most attention in the business plan, as it should. Okay. Because I don't care if you have a company that has a 50% operating profit. If it's only gets only to $1 million of revenue, no one's going to be interested in it. Okay. If you have a company that grows to 100 million in revenue even if it only has a 5%, 5 or 10% operating profit, someone's going to say, well, wait, we have this company over here. We could merge these two companies. We could get rid of accounting and we could turn this into a profitable company. So let's focus on building your revenue model first, and then we'll go into some of those other questions about how to spend the money. So there's kind of two errors that I see all the time when people present business plans to me. And I call the first one the Chinese mitten model. And they say, okay, China has 1.4 billion people, and every person in China has two hands. And therefore, the total addressable market for mittens is 2.8 billion mittens, right? And if we could just get 1%, I can't, let's see, let me see if I can move. Can I move this to, I'm going to move this to the other side. Perfect. If we could just get, sorry here, I'm just trying to get this. There we go. Perfect. If we could just get 1% of the market, we would sell 28 million mittens. And if we sold them at $5 million, $5 a mitten, we'd have $140 million in revenue. And it's a silly example, and we can all come up with a reason why not every person in China needs mittens, and how would we get there, and could we really sell them for $5? But the fundamental flaw of this is that the driver is market share. There's a big market, and all we need to do is capture some small portion of that market. The bottom line is no one deserves any portion of the market. They have to fight for it with, tooth and claw, right? So you can't just say, now looking at the market share is a good validator that what I'm going to propose is a bottoms up approach is reasonable, but it's not a good way to calculate what your sales can be. The other problem that I often see is, I'll call it the checkerboard model. And you start with a penny on square one, and you just say, hey, I'm just going to grow 100% per square. So in square 2, I'm going to have 2 pennies. And in square 4, I'm going to have square 3, I'm going to have 4 pennies, then 8, then 16. And you go, I mean, that doesn't seem like it's a crazy amount of growth to me. And if you continue that to square 64, I usually like to ask the audience how much it's going to get to, but I'll give you the answer. It comes out to $92 quadrillion. You say, well, okay, I don't want to be so aggressive. I'm only going to have a 50% growth rate per square. And in that case, it comes out to $1.2 billion. So the reality is that you have to build your whole model to support the growth rate. So if you're going to increase sales by 100%, you better increase your sales staff and your production staff and maybe your engineering staff by some portion of 100%, rather than just saying sales are going to just take off organically or through all this great social media that we're doing. You've got to build the whole support in the plan to support that growth. So what I'm telling you is the right way to project revenue is a bottom-up approach. And there's a couple models that I'll show you, but that's not to say that this is exclusive. So the sales funnel would be, okay, we're going to make 20 sales calls per month, and we're going to close 10% of those deals. And the average selling price is going to be $62,500, which means at 2 sales, that would be $125,000 per month. At 12 months a year, that's $1.5 million per salesperson. And if we hire 5 salespeople, each making 20 sales calls a month, we should be able to get to $7.5 million in revenue. Now, that doesn't mean you start out with 5 salespeople, and it doesn't mean that but by showing someone this model and building this model into your plan, they can look at this assumption and say, do I think a salesperson can make 20 sales calls a month? Yeah, that seems pretty reasonable. Do I think they're going to close 2 of those sales? Maybe, maybe not. But at least you've got your assumptions laid out someone can either believe or not believe, rather than saying, we think that we're going to capture 1% of the market. Another way would be is that, a lot of people are doing apps, the freemium model. How many visits are we going to get to our website? What percentage is going to download the app? How many people does that mean are going to download it? How many of those actually use it? The number of those that actually use it convert to paid, and then how much are we going to charge them per person, right? And then how much does it cost how much does it cost us to get a visitor to our website? So what's our customer acquisition cost? And the real question in this model is, if these numbers were accurate, is how long is this person going to be a customer? If there's a lot of stickiness with a customer and we think someone's going to stay with us for 4 or 5 years, well, it's worth paying $1,000 to acquire a customer that represents $2,500 in revenue, right? And then I see a number of folks who say they want to do an advertising model, and it's based on how many visits they get to the website and the cost per thousand of views and the click-through rates on the ads, and you can play around with a lot of these numbers. The real challenge is, how are you going to get 100,000 people to your website? What's it going to cost you to get those people there? And what is your customer acquisition cost? Just as a point of reference, there's a website, Yoga with Adrienne. She has 5 million subscribers. 5 million. Her revenue is $2.5 million a year. Now, listen, that's great for Adrienne. And if you could get 5 million subscribers and it's you and someone shooting some videos, good for you. But this is not a fundable business that any investor is going to be particularly interested in. It's just too small. So it's a very hard way to grow significant revenue. So here's what we want to come up with at the end of the day. We want to come up with a spreadsheet. I show years 4 just because it fits on the screen easier. You probably want to go to year 5. And just like we had in my example here, we have year 1, we have the sales, we have the breakout cost by department, and we have the percentages in here. So this is where we want to get to. And let's see let's see, I can't see what is my top. Okay, what will investors look at? When I get a spreadsheet, here's what I look at, and I think a lot of investors do the same thing. The first thing that I look at is, what is total revenue over time, over the period that is in here. Because I'm going to think very different about a company that grows from $100,000 to $1 million in revenue over 3 years, to a company that grows from $1 million to $50 million over 3 years, 4 years, $50 million over 4 years. Completely different mindset, completely different type of business. Okay, so now I go, okay, so these are someone trying to aggressively grow a significant business. The next thing that I look at is that out in year 4, what does their business look at? In particular, I'm looking at the gross profit, because as I said, a high gross profit is the start of a healthy operating profit. And then I look down at the operating profit and see what the operating profit is. And I just kind of glance at where they're spending money: engineering, marketing and sales, and G&A. And see what their costs are. I then go back and look at the operating profit over the 4-year period, because that gives me a pretty good sense of how much money they're going to need to raise to get to 65 million. In this case, they lost $4 million in year 1. They lost $2 million in year 2. They probably lost a little bit of money at the beginning of year 3. So I'd say, 4 plus 2 is 6. Add in some fudge factor. this company probably is going to need to raise $10 million. They're probably not going to get to $66 million, but maybe they can get to $30 million in revenue with a $10 million raise. So that's what I look at. Now, what should you look at when you're putting together your spreadsheet? And this spreadsheet has got multiple pages. Page number 1 is the yearly income statement. And what you're going to be doing as you put together your spreadsheet is you're going to continue to come back to year 1 and look at what these numbers look like. And do I like what I'm seeing? And if not, you need to go into some of the detailed spreadsheets and make changes there. My spreadsheet is color coded to help you understand what's going on. Now, when you present this spreadsheet to someone, take this column source and delete it. You don't need to show that to anyone. I would highlight the page and color everything black, okay? But I color code it so that you can figure out what's going on. So anything that's in blue comes from another spreadsheet. And then we'll see on subsequent pages what the other colors for. And anything that's in black is calculated. So that these 2 blue numbers come from my quarterly P&L, but then I just add those together to figure out what the revenue is, okay? So here's what you should look at when you're reviewing your spreadsheet. The first thing you should look at, the first thing, let's see, what investors will look at, why? What investors will look at. Okay, so I guess I'll come back to how you should think about this. So let's walk through the spreadsheets then. Sorry about that. I'm a little out of phase here. So we've got the 4-year income statement. And then I've got I have it broke down quarterly. And so you could do monthly, but for a 4-year revenue projection, that's 48 columns of information. And there's a question, Ravi?
Yes. How do I get these numbers? Where do they come from?
What do you mean? How do you get them?
You say product revenue is $200,000 in Q2 year 1. Where do you get the 200,000?
All right, hold that thought. We'll show you in a second. We have a lot of spreadsheets to go through, so just bear with me, okay?
Thank you.
So notice our quarterly P&L is all from other spreadsheets. So our $200,000 in revenue in Q2 comes from our sales plan spreadsheet worksheet. Okay, our $114,000 in cost of goods sold comes from our cost of goods spreadsheet worksheet. Our $426,000 in engineering expenses comes from our expenses worksheet. Okay, and we're going to look at those in just a second. Okay, so now we start to get into some of the input. So we wanted to project sales, and so here's your sales input. So I'm projecting that we have 20 units of sales in Q2 of year 1, and that the unit, so we're selling model 1, 20 units, and the cost is going to, or sales price is $10,000 per unit. The spreadsheet, we then multiply just as simple, remember this is black, so it's simply math, $200,000 in revenue, and then this $200,000 is magenta, which shows you that that information goes to another spreadsheet. That's going to our quarterly income statement spreadsheet. So then we have some support revenue, a little bit. What I'm really saying here is that our installed base, we charge them a 15% annual support fee. And for that, they get free updates of software, and they get some warranty protection. And so I kind of show in here how you could build a support revenue model. This whole part you could zero out if it's too complicated for your spreadsheet, but you add this product revenue and support revenue, and there's your total revenue. So the question was, how did I come up with 200,000 sales? Well, you've got to think about, can I go out and sell 20 of these units? First off, you got to think about, what are we selling? What's our model? You know, what is the product we're selling? I've created a generic business plan, so I'm calling it Model 1, but it's whatever you're selling, and it's got a price of $10,000. Now, maybe your Model 1 sells for $10. Well, then you've got to sell a lot more of them to create significant revenue. And if you're selling, instead of 20 units at 10,000, you're selling 2,000 units at $10, or actually it would be 20,000 units at $10. You've got to show, how did we generate 20,000 units of sales? It's got to be some kind of web-based product, because you're not selling these door to door. You don't have an in-house sales force. You can't even make telephone calls to sell a product at $10. So you've got to have, so you're going to have the marketing that would support this. In this model, it's based on salespeople going out and talking to people. If your model is selling high volumes at low prices, then we'll get to the marketing spreadsheet next. Okay. So let's see here. Okay, so we've now got a cost of goods sold. Okay. So cost of goods sold. So what I did here was I just carried these numbers over from my sales plan, so that as I put together my cost of goods sold, I can look at how many units I'm selling to give me a sense of if I need manufacturing staff, how many people do I need to hire, and what's the staffing plan look like. So in this case, to create my cost of goods sold, I've got my manufacturing staff. Some of these are formulas. And so, for example, technicians, I assumed that a technician could build 1 unit per day. And so once my quantity gets above 90, once it gets above 60 units in a quarter, then I need to hire a second technician. Okay. So anywhere that you can use a formula in these spreadsheets, I would urge you to use a formula and put the explanation for what the formula is over here, because you're going to be fat fingering in a lot of these red numbers. And I can tell you from personal experience, it's easy to mistype numbers, to leave something off, and it can really make your spreadsheet look far better than it actually is, or far worse than it actually is. So anywhere you can use a formula, do so. And I'll have some more examples on the next page. So we have variable cost per unit. So in this example, our Model 1, the material cost is $1,500 per unit. But remember, I've got a technician who's got to actually build the unit, and then I've got some support staff in my manufacturing department. I've got a VP of manufacturing and an admin, maybe a supply chain person, to make sure that those goods are in. So that explains my cost there. So we'll talk a little bit about calculating staffing costs on the very next spreadsheet. So as your unit sales kick up, obviously your personnel's going to kick up, and I've even got my supervisor as a formula. So once I get to two technicians, I need a supervisor, and then once I get over 10 technicians, I need an additional supervisor, because one supervisor can manage 10 people in my model. Again, all of these numbers you get to play around with, but it's the mindset of putting this together that I want to impart with you. So staffing plan. You'll see from my rules of thumb that staffing for technology companies represent 2/3 of your expenses. Yes? Question?
Hi, Charlie. Got a question from Simi again. What is the role of a CFO in this process?
Gosh, I hope the CFO is critical and very important, or I would be out of work. So the CFO is really the person who's going to be putting together this spreadsheet with input from everyone else in the company. The CFO is the person who's going to be looking at the cash flow, which we will get to in a couple of pages, and figuring out how much money do we need to raise and when, but also thinking about, can we raise the money? Because just because you say we need to raise $5 million in the next 6 months so that we can last for the next year doesn't mean you're going to be able to raise it. So the CFO should be a little bit of a reality check. Do we think we can raise that money or not? How confident do we feel about raising it? Do we want to plan? Maybe we should plan on raising money in 12 months, but try to raise money in 6 months. Because if we don't, then we can keep our expenses down and maybe last a little bit longer. So, the CFO is a little bit the gatekeeper. He's a little bit the scorekeeper. She is a little bit the scorekeeper, is a little bit the reality check, but is controlling the purse strings and making sure that we don't spend money that we hadn't planned on spending. And just because we planned on spending money, do we really need to spend it based on what's going on in the business? So if your business plan says we're going to hire 5 people next month, but the sales aren't coming in, it's up to the CFO to say to the CEO, hey, we're way behind plan. And if we don't increase revenue, but we continue to hire at this rate, we planned on money lasting us for 9 months. We're going to run out of money in 4 months. And so, as I said, putting together this plan, this is a living document. This is getting adjusted all the time. It's the mechanism to help you figure out how much money you need to raise and when. And it's also the vehicle to present to investors to help you raise that money. So, staffing plan. Staffing is 66% of your expenses, 2/3 of your expenses. It's interesting. I can tell, I'll meet entrepreneurs and they won't tell me, how much revenue they have. But they will kind of get a sense of, they'll be able to give me like a sense of whether they're near break even or not. And then if I ask how many employees they have, I can figure out what their revenue is going to be, because we'll get through that. We'll get to that in another page, but you're going to be coming back to this page all the time, because if your expenses are too high, you need to decrease the numbers here. And if the expenses are too low, if you're way too profitable, it's probably because you didn't hire enough people. So this page, you're going to be spending a lot of time on it. Because of that, I would urge you to keep your categories of employees as short as possible. So if you've got programmers, you don't need to have senior programmer, junior programmer, be software engineer now, right? So you don't need to have 3 different levels of software engineer. Just have one. Use what you think is the average salary that you're going to pay a software engineer, and don't make it any more complicated than that, because you're going to be entering these numbers all day long. Okay. Salary expenses. This spreadsheet is simple, because all you do is you plug in the annual cost per employee, and then it takes the numbers from the staffing plan and multiplies it out, and it adds 15% in to cover the human resources costs, like payroll taxes, and health insurance and any other incidental benefits that you would have in an early stage company. And it also, because of this line here, you can build in, I call it a cost of living adjustment, but you can build in a modest pay raise for everyone over time. And so in this case, I'm saying there's 2% per quarter, which equates to 8% per year, so that it gives you a budget to give people salary increases every year. I mean, guess what? People, it should be no surprise. People like to get a raise. And especially if they're working hard in a startup, even though they've got incentive stock options, they can't buy a new car with the options until the company goes public. So they like to get raises, especially if they're working hard. And it's also a mechanism for you as a manager, for a CEO or a part of the C-level team, to reward people who were working hard and performing, and maybe let those who were not working as hard know that, they weren't quite doing what you expected them to do. So it's a way of signaling to people how they're doing in the company, as cruel as that is, right? So this spreadsheet, you don't spend a lot of time on it because it's all about the numbers from the other spreadsheet. So if you take your CTO, you divide it by 4, that becomes the quarterly. You take 175 divided by 4, you multiply it by how many CTOs you have. You only have one. You multiply it by 115% to add in your payroll tax and your benefits, and now you know what your CTO is going to cost you for the year. And it's the same for all the other employees. Let's look at non-salary expenses. And as I mentioned, this spreadsheet goes out for 16 quarters, okay? And it also goes down, I think I actually show all the departments here, so we'll go down to some of the next ones. So in your engineering departmental expenses, your top one is your staffing expenses, which comes from the prior spreadsheet we just walked through. You then have technical supplies, and here I use a formula. My formula is 2,000 PPPM per person per month. And $2,000 sounds like a lot for engineers to be spending per month. I mean, it's $24,000 a year, but I can tell you, I've managed a lot of engineering departments, and they like to buy a lot of really expensive stuff. That doesn't mean everyone's going to spend $2,000, and it doesn't mean everyone's going to spend $2,000 every month, but they're going to come to you for an oscilloscope, or for some software, or for some new piece of hardware, or for something, for some service that they need. And when you add it all together, if you think 2,000 is too high, then plug in 1,000. But the beauty of having this formula is that you don't need to fat finger this in. That actually should be in black because it's calculated. You don't need to figure that in because it takes the 2,000, multiplies it by the number from your staffing plan, and figures out how much money you're going to spend on that. And I like to throw in some miscellaneous in every department and just kind of play around with that until it looks like a reasonable number and everything kind of looks pretty reasonable. Other expenses would be your sales department. Again, here I'm using per person per month. I'm using travel expenses. In the era of Zoom sales calls and COVID, this is probably way down. So put in put in $500 a month here. But you now have the formula ready to go for when travel opens back up and people start going to trade shows again, and you plug it in. Here is commission. You could put in a percentage of revenue. So that's one way to handle that. General and administration, mainly from the staffing plan, but you are going to have some legal and audit expenses. And then we're going to have rent. And we'll come to rent in the next spreadsheet. And then, telephone and internet connectivity and miscellaneous and other, okay? So where did I have rent? Well, in the actual spreadsheet that you get, what I do is I have a formula based on formula based on square footage per person. Again, the world has kind of changed in the last 24 months, but it's probably going to change again in this 24 months. And office, everyone, and all we're going to do is we're going to rent we workspace for 25% of our office, and we're just going to pay $1,000 a month and keep the math simple. Another question.
Yes, we've got a question. How does staffing costs reflect the equity component of salary?
It doesn't. For accounting purposes, if you issue options to people, you need to do a fair market value calculation and treat that as an expense, but it's a non-cash expense. So investors don't care about that. I mean, venture capital investors don't care about that. It's a cost of doing business, and the only time it becomes relevant is if the company goes public. I mean, in reality, even if the company gets sold, it's noise. It just disappears in the mix. So no venture capital investor is happier than the day you go public. And so if you have to recognize those expenses at that time, so be it. So my advice is ignore them. It's a non-issue. If I don't have to pull my wallet out and hand someone $1, then it's not really $1. Okay. Any other questions?
We've got one more that just came in from Nico. How do investors evaluate whether values for CAC, growth rates, total sales seem right relative to competitors? Do they have benchmarks for specific industries and company stages? And the CAC, for others who don't know, is the customer acquisition cost.
At the end of the day, investors are interested in how big can you grow this business, and does it have a shot at being profitable? Now, look, again, as I mentioned, there's some businesses that it's all about the growth and it's not about the profitability. But I would urge you not to count on catching lightning in a bottle. And at the end of the day, people do like to see profitable businesses, and having a profitable business is good for you, because if your business is at least break even, you don't need to go out and raise more money. And you are in a significantly different negotiating situation if you don't have to raise money than if you do. Let's see, we are done at 7 o'clock, so I am going to have to pick it up here. So so let's move to the next slide. So we've gotten through the whole spreadsheet, and now we're back to our quarterlies. And as you can see, all of these numbers flow from the spreadsheets and annualized. And when you want to build your financial spreadsheets, here's what I would urge you to do. Keep coming back to this page, and the first thing you want to look at is your total revenue and see, is this the company that I want to be building? Because if these numbers don't look right, everything below the line doesn't matter. It's going to change anyway. So until you get that line right there correct, don't bother getting too worked up over what's below that line, okay? The next thing you want to look at is, how profitable is this business? If your business is wildly under profitable or over profitable, you're probably not spending enough money on something out here in year 4. Then the next thing I would do is think about year 1, because it's easy to visualize, and think about what are my key hires? What are we going to spend money on? You should be able to think about everything you want to spend money on in year 1. Year 2 is a little bit of an extension on that. So you say, okay, I can figure out what we're going to be spending money on in month 12. Well, now let's just extrapolate that out for another year, but maybe with an accelerating growth, right? Because we hope to be catching some momentum at that point, right? Look at your percentages in year 2, and then really year 3 is just kind of a, you just fill year 3 in so that it doesn't look like it goes like this. Okay. Cash flow projections. I've got an example in here. Cash flow I have a true cash flow spreadsheet in here. I would urge you not to spend a lot of time looking at that. Use the simple cash flow projection because it's kind of 90% is good and 20% is difficult to put together. All I'm saying is take your monthly operating losses plus your capital expenditures, and that's going to let you know when you need to raise money. And in here, input money, and that will help you determine, should I figure out a way to wait until Q1 in year 2 to raise money? Do we really need to raise money at the end of year 1? Because it's an aggressive time frame, but maybe it's what you need to do. Hello? I'm sorry, I didn't hear that.
Charlie, I'm sorry. I think someone was unmuted. I've just muted them.
So I've got some examples of businesses in here. Retail companies have terrible gross margins and no R&D and not very exciting operating profit. And what I've done is I've gone through various companies and looked at revenue per employee. And I would urge you to track that in your business plans. And we'll look through a couple of companies. And so here's the fast food business. Again, terrible gross margins, except Starbucks is a little bit better than others because it's cheaper to make a grande latte than it is to make a Big Mac, right? But they still don't spend anything on R&D and not particularly great operating profit. And look at here, what's interesting, even though great gross margins at Starbucks, their expenses are so high that they have less operating profit than McDonald's and terrible revenue per employee, right? So, because, let's look at some tech companies. What's I think relevant here is the R&D is in the kind of the 10 to 15% range, and the operating profits, with the exception of Dell, which is really just a kind of a assembler, are higher than 50%, and you've got to be above 50%. And now we're starting to see some decent operating profit. And look at the revenue per employee. Let's look at some software companies. Again, similar R&D here, better gross margins, right? Because they don't have to buy hardware. Revenue per employee, a little bit less for some of these, but again, no one's over 650,000. Okay, now we get to some internet companies. We get to Apple. Okay, Apple, 2 million revenue per employee. Google, 1 million per employee. Facebook, over 1 million per employee, and operating profits in the 35 to 45%. But there's a lot of other companies that are less than that. If your business plan gets to a 30% operating profit, you need to ask, or you get to $1 million in revenue per employee, you should ask yourself, am I the next Google? And you should answer that. The answer should be no. And so therefore, you should reduce your revenue per employee and you should reduce your operating profit, because there's just not that many companies that can sustain that level of operating profit for that long. Okay. Don't delegate building the financial plan. There's software out there. The real benefit is in sweating the details and figuring out what's going on. Generate your sales projections from the bottom up, and absolutely do not do a best case, worst case scenario. Just say, here's what we think is going to happen. Never present best case, worst case to an investor. They're all going to assume the worst case. So the best case is useless anyway. So just present, here's the case that we think is going to be the best. I mentioned this, so don't allocate your expenses. Show your pre-tax profit only. Do not bother to calculate net operating loss carry forwards or anything like that. Don't depreciate your capital expenses. When I said don't allocate your G&A, that means don't send your rent out to other departments. Remove the color coding, the source, and the revenue per employee. I will say these rules of thumbs are for companies that are looking to raise money. If you have a yoga website and are giving classes on YouTube and making $2.5 million, God bless you. But so my suggestions are not going to work for you. But for the rest of you, I think they will apply. We talked about R&D. Let it end up at kind of 10 to 20%. Get your G&A kind of to 5 to 15. And I think by year 4 or 5, you should be profitable at some level, at least 10%, and try to get it to 15 to 20%. In reality, the biggest mistake I see is people come to me with an operating profit in year 5 of 40 and 45 or even 50%. And the reason that happens is they haven't visualized how many staff it's going to take to grow the revenue to where they think they're going to be in year 4 and 5. So grow your revenue to 50 million, maybe 100 million by year 5. Don't grow it to 500 million. Okay. Get your revenue per employee between 250 and 500. And if you have salespeople that are going out and making calls, generally $1 million to $3 million per salesperson is a good rule of thumb. I really don't have time to go through this, but this would, all I'm doing here is I'm documenting that very few companies have over $1 million per employee, and you should be kind of down in this sweet spot down here. And here I'm trying to show you that very few companies have got operating margins greater than 30%, and you should be at less than 30%. Your average salary is going to be at least $100,000, and then employee benefits are going to add some of that. As I said, salaries are going to be 66%. Let me just go to the bottom, to the last page on this spreadsheet. This spreadsheet is in there, and what it allows you to do is everything in yellow you can enter in, and it will flow through the whole spreadsheet. So here I'm going to have 3 founders, and you have to decide how you're going to split that equity. And then what you can do is, as you can see, as you hire employees and as you raise money, there's going to be dilution. So the angel round is going to cause a 10% dilution. The VC round is going to cause a 50% dilution, including the angel round who's going to get diluted. They're going to require you to create an option pool. Let's see, the option pool. They're going to require you to create this option pool. So you can look and see, hey, we started with the three of us started with $1 million, 500, 500. But then you get out here and you say, wow, we ended up with 7% of the company, and Joe got 3.6%. Do I really feel comfortable with Joe having 3.6% if I only got 7.2%? Well, the time to make this change is when you're founding the company, because once you get out here, the die has been cast. I have some rules of thumb of what I think suggested per person percentages at various levels should be. And so when you're building your model and plugging in what you think people are going to get in shares per person, come out to the end and see what they ended up with and make sure that they kind of fit in with this. These are not set in stone, and you could do it very differently, and you could have a very different approach. But I would say that this is not too far off the mark of a lot of early stage companies. So with that, I'm going to stop my share, and we'll take some questions for a couple of minutes.
Charlie, I have a question here in the chat.
Okay.
Charlie, you've talked about what makes a company valuable for investors. Could you talk a bit about what makes it a valuable company for acquisition? Similarly, what criteria you would use to determine if it is IPO-able?
Yeah. So look, the IPO market is always changing, evolving, and windows of opportunity open and windows close. And, the last year or so, the SPAC model has been the preferred way for a lot of unprofitable companies to go. Although I think that they are learning some harsh lessons today when, they went public at $10 a share and now they're trading at $3 and $4 a share. To An acquisition target has got to somehow fit with the acquirer. It doesn't need to be a pure overlap. So maybe it's a market tangential to what the acquirer is going to be interested in. Acquirers like to see strong growth, but they also like to see synergies with their business. And so as you think about your market and your industry, you could, when you're starting your company, you could probably think of 3 or 4 companies that might be acquirers, but recognize that, what you set out to do in day one could be a lot different than where you are in year 3, right? As your company evolves, as the market evolves, and as you get feedback from the market.
Thank you so much, Ray. We have another question from Amy. What's the ideal number of, or I guess, what's the ideal amount of revenue per employee?
So again, it depends on the company, but recognize if you're paying your average employee $100,000 and you have $50,000 on top of that, and you want to have, some profit, it's got to be in the $250,000 to $300,000 range. And look, if you can get it to $500,000 per employee, that's great, but you're not going to have that kind of scale. Look, if you have 10 employees, you're not going to have, $500,000 in revenue per employee. So it's only after you start to scale up that you can generate that kind of revenue per employee. So, but I think 500,000 is probably a good number, plus or minus.
Fantastic. Thank you. Another question from Stephanie and Nico, and somebody we can move on to after that. What made you decide to work for a VC? What was something you learned from that experience that you feel comfortable sharing for entrepreneurs?
So I did it as a summer intern job. I thought I would be interested in being a venture capital investor. But what I realized is a totally different job than being an entrepreneur. You're reading a lot of business plans. If you love that, if you love kind of pushing back, if you love thinking about the overall market and doing it with a different company and a different industry every day, every week, but not really rolling up your sleeves and getting your hands dirty, it's a great job. However, there's a long gestation period to joining a venture capital firm and actually making any big personal money. You've got to stick around long enough to be allowed to participate in the next fund. And then the funds have a 10-year lifetime. So by the time you get to participate in a fund and then you get to receive the rewards of being in that fund, it's a long time. I was too impatient. And so it was a great experience. The one lesson I would say I learned is never send an unsolicited business plan into, may or may not read it. So always send your business plan in with an introduction. Always talk to someone before you send it in.
Great, thank you.
Thank you so much, Charlie. And Nico, if you'd like to go ahead.
Yes. Hi, Charlie. Thank you so much for the presentation. Really useful. So obviously with these projections, they're as good as the data that you put in. So where do you recommend, getting that initial data from? Is it possible to get access to financial statements from similar companies, or do you think there's databases in PitchBook that can give you estimates of how much a similar company at a similar stage would be spending on marketing and so on?
Well, look, obviously any public company, you go to sec.gov and search the Edgar database, and you can go back and look at their 10K and 10Q filings, since they went public. So that's all public information. You can see how many employees they have. You can see how much revenue they have and where they're spending their money. So that's a good source of data. I don't know about PitchBook. I think PitchBook is more focused on the financings, and I don't think that you're going to get any of the detailed financials in there. At the end of the day, look at, I know you say, well, we're not going to be Microsoft, right? But you can look at Microsoft's business model and figure out where they're spending their money, and think about, does it make sense for us to spend our money in the same way? Now, I kind of ran out of time before I could show this, but if you looked at in the business plan template that you'll see marketing and sales expenses are very low in year one because there's nothing to sell. They spike up in year two because we started selling something, and then they decrease in year three as we start to get out into the market and revenue increases. Likewise, R&D is huge in year one, less in year two, even further less in percentage terms. It's in absolute terms, it's growing, but it's going down, down, down in percentage terms as the company matures.
Thank you.
Okay. Sami, did you have something?
Hey, yeah, sorry, this might be a really dumb question, but about how much of these projections do you have complete, and how accurate are they before you even start your company?
So how accurate are they?
Yeah,
they're guaranteed to be inaccurate. Okay.
sure.
Right. So it's I don't want to say it's a wild ass guess. I would say it's an educated guess. Okay. You have to, so I joked about the mitten market in China, but you have to say, okay, what is the market for the product that we're selling? What are the competitors selling? What is our competitive advantage? And I'm sure these are things all the other speakers talked about. But what I would urge you is, you can't say, well, they're selling a product for $100, so we're going to sell it for $90. I got news for you. If you're competing against an established competitor and you are only coming in with a 10% lower price, everyone's going to say, I'm going to go with the safe bet, which is the established competitor, because I could get fired if I buy your product. Now you come in at a 50% discount, someone might say, it's a bit of a risk to try Nuco, but if I could save the company 50% on this product line, I could be a hero. It might be worth someone to take a chance on your company, to at least buy a few to test them out if you can offer that compelling price. So that's where you got to start, is what's the market, okay? And where are we going to come into it? And maybe we sell it at the same price, but our functionality is 2x theirs, and so we can still get $100 per product. So then you have to look at, well, how many of these units are being sold? Thousands, tens of thousands, millions, tens of millions. And then you got to say, how are we going to reach that market? Is it salespeople? Is it the internet? Is it buying AdWords? How are we going to drive business? Is it trade shows? You got to figure out, how are we going to drive people to buy our product for $100? And that's where you get into the marketing spend, and the sales and marketing spend. But if there's a market for 10 million products, 10 million, if there's a current market of 10 million, well, you can certainly justify selling 500,000, but you've got to also justify, how are you going to get the 500,000? Okay. Hope that helps.
Great. Thank you so much. It does. Thank you so much.
It was a good question. Very good question.
Thank you so much, Charlie. I think we're coming to time.
Yep.
Oh, there,
Yep.
there's Joe. Before Joe starts, I'm dropping the attendance link one last time in the chat for anyone who hasn't filled it out yet. Charlie, it was so fantastic. Thank you.
Great. Thank you.
Yep. And Charlie, this is really your session. It just matches the name of the course, the nuts and bolts of how to think about your business and translate it into some numbers, and then go back and think about it again. And this is where the rubber meets the road. And your spreadsheet, when people get in there and start to play with it, you'll see, how easy you've made it for them to do the mechanics of it, and
Right.
allow them more time to think about what they're really doing. So thank you once again. And the spreadsheets that Charlie mentioned are on the website, nutsandbolts.mit.edu/session5. And we'll have your slide deck also.
I think I already sent it, and it did like a Dropbox link in Google
Okay,
Mail.
so we'll
it
get
should
that
be
up.
there.
We'll get that up. So thank you once again. Are you off to ski now?
I'm actually, I am in Aspen now, and I leave for Canada on Friday.
Okay. I didn't tell you that Charlie has this habit of liking to heli-ski, right, where you get dropped on the top of a mountain by a helicopter and hopefully make it down. So we always try to get him to give the presentation before he does that. And we wish you well and a safe and fun time.
All right. Thank you, Joe. Sorry I ran over a little bit, guys, but thanks for sticking with me to the end.
Okay, and we'll see all of you tomorrow when Yonald comes in and talks about what happened at Virtual Lake. So have a good evening, everyone.